Imagine a friend who asks to borrow money. They earn a steady 10,000 rupees every month. But before they even buy groceries, 9,000 of that income immediately goes toward paying off existing loans. Lending them more cash carries massive risk. Their steady income is an illusion because almost all of it is already spoken for. Novice stock market investors make this exact same mistake with corporate debt. They look at a company's bottom line accounting profit and assume the business is healthy, completely ignoring the actual cash required to pay back lenders. If recurring debt payments secretly consume the cash flowing through a business, the raw profit number on an income statement means nothing. To see how this trap works, look at this diagram comparing two companies, StrongBuild and DebtMax. They operate in the exact same industry and generate the exact same annual revenue. We can even look at their operating profits. EBIT stands for earnings before interest and taxes. It is the money a company makes from its core operations before paying lenders or the government. Here, both companies generate the exact same EBIT of 500 crore rupees. A beginner scanning financial websites might notice DebtMax trading at a price-to-earnings ratio of 8, while StrongBuild trades at 18. They buy DebtMax, assuming it is a massive bargain. Buying a stock solely because of a low PE ratio is a dangerous trap. That cheap price tag often masks hidden obligations, pulling cash out of the business from the inside. To uncover the actual debt burden, we use the formula shown here, the interest coverage ratio. You calculate it by taking a company's EBIT and dividing it by its interest expense. This metric asks a very direct question. How many times can a company's operating earnings cover its borrowing costs? Watch the calculation for StrongBuild. We divide its 500 crore EBIT by its 100 crore interest expense. The result is 5. StrongBuild earns 5 times what it owes, leaving a massive buffer. Now look at DebtMax. It has the same 500 crore EBIT, but a huge 400 crore interest expense. 500 divided by 400 gives a ratio of 1.25. Almost every rupee it makes goes straight to the bank. Both companies report the exact same operating earnings, yet StrongBuild operates with a wide safety net, while DebtMax balances on a financial tightrope. Now we run an economic stress test. A slowdown hits the sector. Demand drops, and neither company sells as much product. This chart tracks the impact of that downturn. You can see the vertical profit bars for both companies shrinking simultaneously, dropping from an EBIT of 500 crore down to 300 crore. We recalculate StrongBuild's ratio against its fixed 100 crore interest line. 300 divided by 100 equals 3. Even with dropping profits, it remains safely in the green. It easily pays its lenders. But watch DebtMax against its fixed 400 crore interest line. 300 divided by 400 equals 0.75. The bar plunges into the red. DebtMax no longer earns enough to cover its basic interest obligations. When a ratio falls below 1, the math breaks. To survive, the company has to drain its cash reserves, sell off vital assets, or take on new toxic debt just to pay off the old loans. A company's structural integrity is invisible during periods of rapid growth. You only discover if a business is built to last by testing its ability to survive an inevitable economic downturn. This brings us back to our initial valuation. DebtMax's low PE ratio was never a bargain. It was the market accurately pricing in the massive risk of default. This is why professionals look at the scale shown here, weighing PE against EV to EBITDA. EV stands for enterprise value, a metric that factors in a company's total debt. When you weigh the two, DebtMax's apparent value disappears. By adding that massive debt load into the equation, the math flips. The heavily indebted company actually becomes much more expensive to own than the stable one. Cheap valuation metrics are useless if the underlying earnings are structurally fragile due to overleverage. This does not mean a company should carry zero debt. Highly stable industries with predictable cash flows, like utilities, can safely run lower coverage ratios. Volatile commodity businesses need a much wider margin of safety. You can see the universal investor benchmarks on this dashboard gauge. A ratio above 3 sits in the green zone, indicating financial health. Dropping below 2 hits the yellow warning sign. Anything below 1 enters the red zone, signaling critical danger. If a company increases its profits by piling on crippling amounts of debt, the growth is an illusion. The business is simply living on borrowed time. Never evaluate a company's earnings without first asking how much of those earnings belong to lenders. Survival always precedes growth.